Hey everyone, welcome in to another daily editorial here on the KE Report. In this daily editorial, we're going to be chatting about the short squeeze in silver that we discussed with Craig Hemke just last week. And well, unfortunately, it looks like that short squeeze might have ended, but hey, silver did add on about $1.50 in just a matter of a few days. We'll also talk about some of the earnings out of majors, including Newmont's earnings today that unfortunately have been quite the selling event for that major. Craig, just a quick comment. You were spot on when you were looking at the commitment of traders reports for silver and saying that it looks like there's a bit of a short squeeze setting up. We saw that last week as silver went from about $22 up to about 23 and a half. It's starting to give back some of that as we're now back at just under $23. Take us through any changes you saw in the COT report for last week for silver.
Well, hi, guys. Yeah, in periods like this, when volume is light and trading is light and, nobody really cares, the trends or understanding the historical trends, let's put it that way, in the way that commitment of traders report shifts with price can at least give you some idea what's going on and what to expect going forward. You, of course, can never use commitment of traders data for actual trading. I mean, you think of last week's report. It was surveyed last Tuesday. What was that, the 13th? On that day, silver fell 61 cents and open interest was up 6,000 contracts. And you knew it was this big, huge rush of speculator hedge fund shorting. Now, if CFTC had come out and told us that on Wednesday morning, we might have been able to go, yeah, let's ride this for $1 and make some money. You had to just kind of go on faith that what we thought was true would be confirmed by Friday when they finally release it 74 hours after the survey. So now what's happened this week? Because we had another survey on Tuesday. Well, all of that fresh shorting that came in the previous week that we saw in Friday's report, a lot of that now is being, that got covered. And now we're going to see it reflected in this week's commitment of traders report, because after silver fell the last couple of weeks and all those spec shorts came in, this week silver was back up 97 cents. And again, by this week, I mean Wednesday the 14th through Tuesday the 20th, those 5 days. And gold's back up as well. And there were a whole bunch of shorting that had come into gold. So what happens? Again, price falls, speculators are shorting, open interest rises. Price then squeezes back up. Speculators are kind of squeezed out. They have to cover their shorts. And as they do so, open interest falls. And it's this pattern just kind of oscillating back and forth. It would be nice if silver had bottomed and began to extend. It got briefly above the 50-day moving average back on Friday, only to be, jammed right back below at the Asia Open on Sunday night. If it could extend from here and trade above 23.50, there's a really nice double bottom at 22 on the chart. Unfortunately, it looks instead like now we're headed back to 22 again, as those very same speculators that were sucked in on the short side 2 weeks ago, got squeezed last week, are now coming back in on the short side again this week.
Craig, the cyclicality of the traders on both sides of the silver market. It is pretty interesting to watch how the trading action and price action acts after some of these reports come out, and when you see the positioning of the banks versus the hedge funds and the tug of war that's always going on there. I guess just shifting over into the beleaguered mining stock sector, which is really what's driving the sentiment more so than I think even the price action in silver or gold. When you look at something like the earnings reports, they've kind of been a mixed bag in some of the majors. As Corey mentioned, Newmont today not doing so hot on its numbers as the kingpin leader in the gold mining sector, but some of the other companies like Agnico Eagle or Kinross, and even to a lesser extent Barrick, put out okay numbers. What's your general takeaway from earnings season here with some of the big boy mining companies?
Well, I owned a little bit of Newmont. I finally just said, you know what, the hell with this today. After writing it down, I had a whopping 300 shares of my the people on my site. If you're a subscriber, I post all of my holdings, and you could see it across my little IRAs and my SEP IRA and my, personal accounts and stuff like that. So it's not like Newmont was like some big part of what I own. You just try to diversify amongst the majors and the juniors and the exploration, how everybody else does. But what a dog! I mean, Newmont is back to trading at $32 a share. The last time it was there was back in March and April of 2019. And back then, gold was 50% lower than it is now. And so their primary product has increased in price by 50%, and they've done nothing, obviously, to improve their margins, their ability to spit out what people call free cash flow. I'm no CFA, but when you see that their all-in sustaining costs, whatever, $1,400 they report, their principal product is above, or near $2,000 the entire time, or actually probably almost above $2,000 the entire time during the quarter. So they're making $500 an ounce in just basic math. I'm sure that's more complicated than that. And yet they still can't make any money. I mean, it's like, what is, I mean, they're obviously it's a very poorly run company. And I'm sure it's the largest miner in the world. They probably have senior vice presidents and executive vice presidents and councils for this and management of that. And I mean, come on, some point you need to figure out a different business plan. As you said, Shad, there are others that seem to be doing okay despite the depressed sentiment. So anyway, I just find it frustrating to look at some of these. And I'm mad at myself, I guess. I've held it as long as I did. There's still going to be great times for the miners ahead. But man, if that doesn't augur, doing your own homework and being selective on the ones you own, I'm not sure what does.
Well, the problem here, Craig, is that even with some of the record production numbers, record revenue that we've seen, none of these majors, or maybe one of them or two, are at 52-week highs. Most are right around 52-week lows. And quite frankly, whether we like it or not, the majors are a barometer of broader, bigger money interest. Clearly that interest isn't there, I guess because earnings just aren't as good or better than expectations, even when they were record levels. Again, still not drawing that money in, but as you said, gold's at 2,000. So where's the disconnect here? We can't assume that these miners are all of a sudden going to bring their all-in sustaining costs down to, let's say, 1,200 or 1,000. So are we still just kind of sitting here, I guess, waiting for that major gold breakout to bring in some money?
Well, that requires kind of a long and complicated answer because there's so many things that factor into rising demand for the shares. At its most basic level, it's kind of the old argument of value versus growth, right? Right now, growth is all anybody wants, right? Look at NVIDIA and all the different artificial intelligence stocks, and if you don't double your money in 6 months, what a dope you must be. Where a value stock pays a high dividend, and you can kind of chug along and feel like and that's completely out of favor. I mean, there might be a few what you would consider value companies, not in the mining sector, I'm just as a category, that are doing well or attracting funds, but really it's all about growth. And so one, you've got to have a general investment shift in attitude, more oriented toward value and away from growth. And we've seen a little bit of that. I've read things on Twitter about Bezos selling $6 billion worth of his Amazon stock, and Buffett and Gates repositioning themselves, Stanley Druckenmiller moving into Newmont. Way to go, Stan. Anyway, you can start to see some of that, but it's just the perception of a risk appetite and where you want to be. So on a larger scale, to answer your question, Corey, because there's so much underneath that, that's one of the first things that has to happen. There has to be a sector rotation. And for now, that just doesn't seem to be in the cards. I mean, we might have been on the cusp of that yesterday when everybody was all focused on NVIDIA and their earnings and everything like that. But that I think has been postponed indefinitely again, as everybody just chases the Magnificent Four or whatever's left of the Magnificent Seven. I add one more thing, and it encourage maybe people can check this out and find it. There's a guy I know named Michael Leibowitz who writes articles with another guy at his company named Lance Roberts. They write a site called Real Investment Advice. And Michael's a smart guy, and he's been around a long time. And I was talking to him last week, and he said he's working on an article comparing today's investment climate with this Magnificent Seven versus the Nifty 50 from the 70s. And it's been on my mind. I've been talking about that at my site for a couple of years now because there's so many other parallels to the 1970s. Where we are and inflation and real interest rates and, malaise and everything else. And that Nifty 50 versus the Magnificent Seven stock market driver has been on my mind too. Anyway, Michael wrote about this. Anybody can probably go look it up. But until we break that Magnificent Seven growth biased investing, maybe we're just doomed to just kind of, continue to be frustrated. That, like I said, that's a big umbrella, and then there's stuff underneath there as to why the shares are doing what they're doing.
Yeah, Craig, I do think it's a unique market here, and no market's ever the same. And a lot of people go backwards in time and try to draw correlations between other periods. But, in other periods of time, there weren't ETFs, there weren't cryptos, there weren't cannabis stocks, there weren't AI stocks. So it's a different environment. But just one more follow-up on the companies. When you look at these companies, I think you made a great point that it's a nuanced answer. It's not as simple as just gold price going higher. There's a lot of sentiment that's baked into this too. Because if you look back to 2011, 2010, the margins for these mining companies when they were at record high valuations were between $450 and $600. Well, right now, some of these companies cost are around $1,350, let's say $1,400. Well, gold's at $2,000. That's still a $600 spread. Their valuations are massively, massively different than they were back then, and it's the exact same margins. In 2016, when we saw that big rush that everybody likes to reference, the margins were $450 to $500. Their margins are better now than they were then.
Yeah.
So even if gold takes off $100 or $200, yes, it's going to help. But it seems like it's more of a sentiment thing, that the sentiment is not there because people are making money elsewhere. How much do you think sentiment plays into these valuations versus just strictly looking at the margins, which are honestly no different than they were? They're even better than they were in prior periods where the valuations were much better.
Yeah. And Chad, I think that goes to what we were just talking about. Is that, it's just a sector. Why would I even fiddle around with that? Especially when you said that, as you said, there are now other alternatives that are siphoning off demand. Where, it used to be even 15 years ago, 10 years ago. Well, I want something that's kind of non-dollar based, outside of the regular investing mantra. So let's buy some gold miners. Now it's like, well, you want that same thing. And let's buy the Bitcoin ETF. Let's go buy, there are all these other things that kind of compete for the same little slice of the pie. And so then you throw that on there with the sentiment. Again, that's all part of why we're all just so confounded. Now, there are some things, we've talked before about obvious, clear, 95, 99% correlation between the price of silver and the GDX. Hey, something turns and happens and silver goes to 40, the shares are going to go up and we're all going to feel real good about things again. But in the meantime, it just baffles my mind. Again, maybe these companies are all brilliant executives that make all these, decisions and strategic plans and, and all the other corporate jargon. But I just don't understand why they can't manage all of their, their expenses that go into that all-in sustaining cost better. Somebody told me once that I ask too much of these guys because at the end of the day, it's like now I'm really going to go off on a tangent, but Corey, you're a big football fan, and we sit there and watch football, and everybody screams at the TV, and they're like, "Why did that coach not, why did they not throw the challenge flag? Why are they not calling a timeout?" And I got a good buddy of mine who used to play football, and he says, "You got to remember, most of these head coaches are just meathead former players. Some of them, they're smart, but they're still just former players." And the same thing is true about a lot of these mining executives. They're not. Yeah, maybe they got an MBA and stuff like that, a few of them, but most of them are just rock breakers. They traded in their pickaxe for a fountain pen and moved into the executive suite. And so maybe, in some cases, we're just asking too much for them, of them in terms of a forward thinker business planner. I don't know. Again, this is big picture stuff on a day when I'm just in a bad mood anyway. But nonetheless, I think all of that plays into why some of these shares, like I said, Newmont, I could pull up a chart. I'm sure they're not only at the lowest level since 2019, but hell, you probably can go back to 1999 and find share price at about the same level. So it's just a very frustrating sector. You really just can't sit and buy and hold. You got to really stay on top of things.
Yeah, that continues to be one of the problems. But hey, back to the management of these companies. Look, after the last bull market, everyone was saying these companies need to focus on production, build up cash levels, don't go out and make bad acquisitions. In all fairness, that is what they are doing over this, if you want to call it bull market, where they are building up cash. They're trying to focus on their margins. Percentage wise, unfortunately, their margins are a little bit off in about that 25% range. But they are doing what the market asked them to do last bull market when everyone said they screwed up, but they're still not getting any love, Craig. So it seems like this never ending cycle.
That's why I've just put everything I own into NVIDIA, and I'm just going to ride the wave, man.
Man, you would have done excellently doing that.
I'm thinking about starting the TF NVIDIA report. You think that'll get me anywhere? I love it. No, you make an excellent point. And I don't know. Yeah, maybe that's just all part of the cross we bear, Corey, is that we are involved in a sector that fundamentally makes so much sense, and but it's aggravating to watch on a daily basis. We'll have our day again, no doubt about it. You get you see the long-term, just like the GDX, and you get these 6-9 month periods where everybody's excited and things are screaming higher. And we had one in 16, we had another one in 20. So maybe we're due again in 24. But just, hey, remind me when next time we have one, can you guys just put a little reminder in your phone to tell Craig to try to sell once the thing rolls over? Because next time probably won't be different.
Well, Craig, is there anything on the macro landscape that you think could change the dynamics? I know we've talked a little bit about this in the past, but is there anything that, because we're in a new environment, we're in a strange environment, a post-pandemic world where there's all this liquidity. We just had this wild rate hiking cycle from the Federal Reserve. We've seen the labor markets act in a way that is exactly the opposite of what people expected. We went from recession to a soft landing to, hey, maybe we're going to have an accelerating economy. There's all these different narratives racing around. Is there anything you see on the horizon that could shift the narrative and maybe put a little more focus back on resources in general, but also the precious metal sector?
Well, it is the world that we live in, my friend. And there was a reason why I entitled my annual forecast last month, Waiting for Jerome, because the way these markets operate, run by algorithm, 90% some days volume, all just bots, until the monetary policy shifts and the theme shifts away from higher for longer to actively, cutting rates and increasing liquidity and that kind of stuff. Here we'll sit. Now, on the bright side, we've gone from, extreme over-the-top optimism about rate cuts in 2024, when we were talking about 7 or 8. And I think right at the beginning of the year on January the 2nd, I've got a rate cut expectation chart that showed 100% likelihood a cut by May. That now that likelihood's down to like 20% or something. So we've weathered that, and gold's only off a couple of percent. So that's good. But in terms of getting the ball rolling and getting through the technical resistance and everybody seeing the clear breakout above 2100 or above 26 in silver, that sort of thing, we probably continue to wait for Jerome. And so we got to watch the macro data. We'll see if the employment stuff begins to roll over. If it doesn't, for political reasons or economic reasons, whatever, then we'll just continue to wait. And again, very frustrating for everybody. But it just is what it is. And there's not much we can do about it except, like I said, try to be patient, understand this physical situation. You kind of buy the dips when things go down. And then, again, I hate to say this because people will always say, well, I've been waiting for 15 years. Yeah, well, so have I, bub. We're just going to have to wait a little bit longer until things change.
Yeah, it just feels like we're in this never-ending fight with the markets, right? Saying, well, it should be going a different direction, but the market's going this direction. The market's wrong. I'm going to be right. And you know what? That time will come. But as you said, Craig, it can be a long and painful wait. We'll chat again next week, Craig. Go have a beer. I will too. Have a great rest of your week.
Thanks for the long and painful podcast. Yeah, we'll talk to you next week, guys.